Hey everyone, if you've got $100 you're looking to invest in the stock market, then I think Disney is one stock that's a no-brainer buy at its current share price of $85.46. Now, when I'm looking at a no-brainer buy, the way I'm thinking about it is this stock, the price of this stock 10 years from now, I'm almost certain that the price is going to be higher than it is today. Now, I can't say 100% because nothing is 100% when you're investing in the stock market. But the way I think of it is it's highly probable that Disney's stock price 10 years from now will be higher than it is today. You could look at its history. $85.46 is just about lower than this stock has traded for going all the way back to around 2014, 2015. Now, there's reasons why Disney stock is selling at this discounted price. It's because the cable segment, the linear segment, is declining rapidly, faster than most analysts had expected. Consumers are switching to streaming consumption, and that's hurting Disney's linear segment. Overall, though, consumption of content is increasing. People are consuming more content because it's more convenient now. You can watch your content almost anywhere you can get an internet connection. And so that means you're watching more content. However, that transition going from cable connection to streaming connection, the delivery method, is going to be messy. It's going to be choppy. It's going to cost money, the transition, and all of that. So it's justifiable to see Disney stock price down as a result. Still, if I'm looking at long term, over the next 10, 20 years, Disney stock price is probably going to be higher. I feel like it's a no-brainer. You just buy it for 85 bucks, put it away for 10 years, and look back at it 10 years from now. It's probably going to be a higher price. I don't know exactly how much higher, but probably higher than it is today. And I can show you a few of its metrics. You go back 10 years, Disney's revenue has grown from around 45 billion all the way up to 87.8 billion. Of course, I was just talking at length about its linear segment, but I haven't even mentioned the theme parks yet. Think about if you've gone to a Disney theme park 10 years ago and you've gone to a Disney theme park this year, you probably paid much higher prices than you did 10 years ago. Every year, Disney seems to be able to pass along higher prices to customers, and every year the theme parks seem full, right? I've never gone to, I live here in California. I've never gone to any of Disney's theme parks here, Disneyland or California Adventure, that were empty or where the lines were not in excess of 30 minutes for the less popular rides and more than an hour for the more popular rides. The parks are seemingly always full, despite the fact that the company's raised prices significantly over the last decade. That part of its business is thriving. It's more profitable than ever. And so when you're buying the business today, you're getting a business that's generating a higher percentage of its profits from the theme park segment than any other time in its history. So the part of its business that I'm most bullish about, the theme park segment, is now a greater percentage of the company's total profitability. Now, that's probably not going to be the case over the next 6 or 7 years or so because the streaming segment is going to grow to become ever more important. It's just right now, as the company is making the transition, the streaming segment is still generating losses. Now, you could see it evident here in the company's operating profit margin, where it was generating margins closer to 25% in 2016, 2017. And then as the transition to streaming started around 2018, 2019, you started to see the company's profit margin decline. And then the pandemic was terrible news for the company because it had to close the theme parks and profit margins declined further. But now it's recovering. It's back up to 8.49%. And I suspect over the next 10 years, this profit margin will recover in the double digits. I don't know if it'll ever reach 25% again, but it would be reasonable to expect it to exceed 20% because at maturity, Netflix's operating profit margins were around 20%. So it's reasonable to suspect that streaming industry profit margins could be 20% or above 20% as well. It doesn't have to be a money losing business. It's just a transition that's going to be costly to invest in the technology, in the marketing, and the content, and then you can reap the benefits later. And you could see that with the company's cash flow too. It was generating cash flow from operations in excess of 12 billion, and that dipped below 6 billion, and now it's recovering back up to 7.5 billion. Still, the company is comfortably profitable, generating billions of cash flow. It's doing okay, even though that one big part of its business is losing millions of customers. Those customers are not going away from Disney, they're going away from cable. That's the key thing to remember. They're not saying we don't like Disney. They're saying we don't like the cable connection. We want a streaming connection. We still like Disney content. We just don't want to get it through the cable connection. And so longer term, it's going to be neutral in my opinion for Disney going from cable to streaming. However, the transition, like I said before, is going to cost a lot. But you're getting that in the valuation, right? Disney's stock price, we saw it's lower than it's been almost in 10 years, right? And you're getting it at a forward price to earnings of 17.24. And these earnings are more sustainable earnings than they were in 2017, let's say, right? Because in 2017, you were still getting a business that nearly 40 to 50% of the profits were coming from the cable segment. And you knew that was not sustainable. You knew that eventually people are switching, right? That was happening even in 2017. It just accelerated during the pandemic. And so now you're getting a business that's not consisting, the profit, overall profit coming from the cable segment is much smaller than it was in 2017, 2018. So you're getting a business with more sustainable, the earnings that you're seeing now are more sustainable, and they're going to grow because the streaming segment, according to management, is going to be profitable in 2024, starting in 2024. So you're going to see that part of the business start to increase in profitability. So for all those reasons, I think if you've got $100 to invest and you can put it away for a decade, then Disney stock is a no-brainer at $85 per share.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.